let's talk about options on futures. Comparing SPX to ES, because a lot of you have probably traded SPX but not ES, maybe futures but not options on futures. Overnight risk, none for ES, because it's basically open all night long. So you can trade and you don't have to worry about being stuck in an SPX trade where the market is moving in one direction or another and it moves against you, and that's not good. You can wake up with a big loss. The multiplier is different. It's 100 on SPX and 50 on ES. There is greater margin requirement for SPX and less margin requirement for ES. And we'll look at the numbers there in a second. You have the ability to roll into later expirations for SPX. Rolling is restricted to only within the same contract, the same expiration on ES. And so what you have to do is, if you're going to roll it, you have to close the trade and move it to the next contract. SPX is cash settled. ES is future contract settled. Now, let me tell you how that works. If you're within the spread of your futures contract when you're expired, you'll be assigned the futures contracts for whatever positions you have. If you're max loss, it's cash settled. Basically, they take the money. And then if it expires under the spread, then basically it's also cash settled. That's kind of how it works. Commissions, fees are less expensive for SPX, and commissions and fees are more expensive for ES. So let's compare same contract, apples to apples, for SPX and for ES. So this here is 38.40, 38.60. So now remember, when you're trading futures, the contract does have an expiration. And so there is decay in that futures contract. And then when you open up a new futures contract, when the other one's expired, you'll see a big difference between SPX and the ES. At this time, when I was looking at it, it was a 20-point difference. So you're actually looking at apples to apples placement of this trade, and that's why the premium is the same. But not really. The premium, here it's 110 and here it's 80. This is the multiplier effect. So it's one contract and you got to divide this by half. So it's actually 55. And so you're trading a 55 contract here. What you're going to get, that's your premium. It's not $110. It's actually $55. And here it's actually 80 cents. So that's how the multiplier works in this trade. And you can see here too that the credit is $77 here and $51 here. But your max loss is $445 and $920 here. So basically half the price. So that's why you can trade this in a smaller position. So now let's look at how it really works and make a different comparison. So here now is a real comparison, because we're still at the 20-cent difference from SPX. However, this is 80 cents. This is $1.60. So the premium is the same. However, what we're doing now is we put a bigger spread. Now we have a 15 wide spread instead of a 10 wide. And that's what I trade. I trade a 15 wide instead of a 10 wide. And it basically gives me the same premium as SPX does. And that's how it works. The good part about this is that the credit is the same, but the margin is lower for ES. So you can actually trade more contracts for the same amount of premium. So that's basically how it works. It's a more favorable trade. However, the commissions and fees are higher, and you can negotiate that with your broker. But I know a lot of people now that trade ES options on futures because the margin requirements are much lower. It's basically over 20% additional buying power that you have on ES futures. No PDT, no overnight risk, lower margins. I mean, there's a lot of things going for this trade. So now let's talk about threatened trades. So the entry is you enter the spreads within first hour of the overnight session. So that's one way to trade it. Profit is taken, confirm tops and or bottoms, and re-enter the trade. Premium should be within 115 to 140. That's a delta of 6 to 8. I also use less than that for my bear spreads. And the reason for that is because they're always closer to the money, just like SPX. You take profit, 10 cents to 5 cents, and then exiting the trade, you use 2x, 3x stops. That's really the best way to manage these. And just take the loss and then, or within the next expiration if you have enough time, or you're moving the position to the next expiration. So within the expiration, you can actually roll the trade, but I don't normally do that. Close the threatened trade and open a new one. That's what I mentioned. Now, the entry, this is something that's kind of changed, because when I normally put on these trades, I put them on around 2 o'clock. 2 o'clock, the implied volatility is kind of high at that time, because you know what happens at the beginning of the market, right? Where IV is high. We all know that. But around 2 o'clock, a lot of times there are reversals that happen around that time. And so the IV is higher. And so you can track this. And so what I like to do is I like to put on these trades around 2 o'clock, 1:30 to to 2:30, sometimes to 3. And you'll see that these things get kind of crushed at that time. The rate of change goes quicker at that period of time. And so that's when I like to put on these trades around 2 o'clock in the afternoon. And then what happens is I hold them overnight and I close them at 10 cents. Usually around 1:30, these trades kind of close. So now when it closes, I'll wait for an opportunity to try to get a directional trade so that when I put on a directional trade, let's say it's bullish, I get some move up, and then I'll put on the bear spread. And so I'm ahead of the game right at the beginning, along with your theta decay. So that's kind of the best way to put on these trades. This is basically the first time that I've explained this like this in a webinar, because my first webinar on this was kind of figuring it out and how to trade it. But now I've really figured out how this works. For me, this is the best way to trade it. Yeah, 2 p.m. Eastern time. Hopefully I'm giving you a lot of good information here, guys. All right. These are trades from before, very similar to the trades I do now. I have to update it. Sorry, but this is for November, but this is pretty much exactly the same, other than traded up to 4 contracts. And now I'm trading 3 contracts, and I trade these every single day, pretty much every single day. So here's a good explanation. And I'm going to show you real trades that I've done, good and bad and ugly or whatever. So I'm not going to tell you everything is rosy. So these are real trades that I've traded, and I'm going to share those with you. Put on 324, a little late when I put that trade on. 10:15 a.m., I closed it on the next day. Well, it's because the market went up on the next day. I sold one at 10:16 a.m., which I don't normally do, and then bought it back at 5 cents, probably because the market went up again. So that was a directional trade. So then I sold a put spread, 120, sold it at 341. Again, that's a little late than what I would normally do. And during that period of time, the market went up and I took my profit. So another directional trade. This is what happens on these trades in the end of the day. But again, when it goes against you, you have a lot of time too. So I kind of just let that go until it gets a point that it's really threatened, and then I have to close it. But the market can go against me, and then it'll move again in a different direction, and it'll be fine. So most of the time it works. That's the high probability part of the trade. So let's go through some real examples here. This is a trade that I put on really incorrectly. So I started with a call thinking that the market was going to go down. It didn't. Then I scrambled to put on the put side. And so this is lopsided, completely lopsided. So you can tell what would happen. So I closed that trade. And then what happened was I got killed on the other side, and I had to close that trade as well. So these are losses. And so this was the loss for 2 contracts. So you get a feeling for what this is. So let's go to the next one here. So at 10:15 a.m., I closed this trade and sold a 37.30, 37.15 put spread. And then I closed that trade, and you can see the market went up and it went way down. And then when it got up to here, I was able to close it. So that was a nice trade. And then I sold a put spread for $1.20, went higher. Okay. And this is basically what I showed you in that diagram. And I took profit on it, closed it. So here, total returns were $285 on this trade. Okay. Next trade. Sold 37.60, 37.45. And you guys can see, right? Went up a little bit, and then went right back down. And then I put a call position. This is the way you should do it. So basically this was range bound in this trade here. And then the call went down, obviously, and then I got out of that trade. And then the other position closed it basically at break even, because I didn't want to get stuck with a big loss. I sold a call here, and then I closed it when it was moving down here. And so this was the same day. So 10:25, and basically it was a directional trade. And then on this one here, I was assigned on this trade. So I got basically a futures contract at 37.60. And this can happen, as I mentioned to you. And then I sold that contract. And so basically it was a $35 gain for this position. All right, next trade. Started at 4 p.m. to 8:30 the next day. So put it on right at 6:34 p.m. So back then I was putting more of those on. I put on one side. When I don't get a favorable position, I may wait until the overnight trading starts, and then I'll place it. So in this case, I sold a put here, and this is exactly how you have to do it if you can catch it. And then you want to sell your call way up here. And so by that time, I had a lot of premium from 6:34 to 12:30 a.m. and I wasn't sleeping. So I did put that on. So I bought the call back. So I sold it. I bought it back for $1.10. small profit, and then closed the put spread for 95 cents. So basically small profit. And again, my trades now are much better. This was in November. Okay, so here is another example, 8:35 a.m. to 5 p.m., same day. So I put it on at 9:46 a.m. and closed it a couple hours later for 10 cents. Then I sold a put again and bought it back at 45, $82. So here I sold the put and I sold a call pretty much in the same time. I closed the call at 9:39 a.m. the next day, and I closed the put for 10 cents. And then I sold a put when the market went down and I closed it, expired. And I don't usually let trades expire, by the way. And that was $137. So generally now what I do is I trade 3 contracts and I usually make $250 a day on trading these, except when I have to get out of a position. But normally that's what I take in, $250 a day. And then for 4 contracts, I was pretty much making $400 a day. And I rolled that back because I took a loss and I wanted to start over again and get my stuff together. So that was a trade.